Hi everyone, my name's Steve Livingston and welcome to this first edition of the Getting Funded podcast. Really the aim of this is to share with you some ideas, tips, information around UK tax incentives that exist to help companies, startups and growing companies access funding using tax incentives such as the SEIS and EIS tax reliefs. We're going to cover it over a series of editions, trying to make it sort of long enough to get information in there, but equally short enough so that you don't get overwhelmed. Go at your own pace, so we put them out there as quickly as we can, and we're really using it as a basis to answer the sorts of questions we get asked on a daily basis. So here we have it in an audio format that you can access at your will. We're also going to put it on YouTube as well, so look out for the YouTube channel on Getting Funded, and we'll put links in the show notes to this. You can find us at iptaxsolutions.co.uk. We've also have a blog at businessn2k.com, so we'll try and link all these shows there as well. This first one is going to cover Seed EIS, really in a nutshell, a little bit of information about it and what it is, how it works. I need to give you a bit of preamble to start with. Obviously, this is just a kind of high-level intro across a series of these podcasts. To advise, you get professional advice if you're looking at anything in particular, but we are trying here to give you access to this information as freely and cheaply as possible so that you can get on and raise your funding and build your services, products, whatever you want to do. So I hope you find this useful. We're going to kick off, as I say, with CDIS in a nutshell. So what is CDIS? It's basically stands for Seed Enterprise Investment Scheme. Enterprise Investment Scheme already existed. Came in a number of years ago. The Seed Enterprise Investment Scheme came in 2012 to really deal with early stage companies and help them access funding. It's a government incentive, so there's no kind of racy sort of tax scheme here. This is a government scheme to encourage investment in privately owned, unquoted UK trading companies. So the unquoted bit there, if you're a limited company, you're going to be unquoted. We're really talking about here about sort of stock exchange listed companies in the UK. So if you're on a recognised stock exchange, then you can't qualify for either CDIS or EIS. Interestingly, AIM isn't counted as a recognised stock exchange for these purposes. So it's possible in theory for an AIM listed company to qualify for CDIS and EIS. As I said before, it's aimed at early stage companies, and in a future episode we will cover what we mean by this, but broadly looking at companies that have been trading for less than 2 years. For companies that have been trading for longer than this, you've got the EIS scheme, which you can use thereafter. So again, we'll come on to this later in another episode, but it's fairly common for companies to start off with CDIS and then to go on to EIS afterwards. So they can work in combination, and there are certain things you've got to watch there. The rules are changing on this interaction, the two schemes, and we'll cover it in a future episode. So if you subscribe, you should get to that one in due course. And it's great for companies looking to attract investment. That's what it's all about. It's all about getting investment into your company, getting funding. It's great for the company in that it makes you more attractive, because otherwise, why would an investor, a private individual, put money into your company? Given the kind of failure rates of companies, there needs to be some sort of carrot there to get investors to invest in the sort of less obviously liquid stock, which is a investment in an unquoted trading company. And equally, it's great for investors too. We'll come on to tax reliefs, but they are very, very generous, and that's to really encourage people to put their hands in their pockets and make an investment in your company. So it works both sides. It's great for the companies, as I say, to get investment in, and really it's aimed at the investors to get them to put their hands in their pockets and put some cash into your company. Sort of one downside here, as things stand at the moment, at the time recording this in April 2015, it is in exchange for equity. So you do have to issue shares for these schemes for both CDIS and EIS, so you are giving away some of the pie, so to speak. Obviously, people have different views on this. It's very much a case of people say, well, you want to hang on to as much of the company as possible. But then equally, to grow a big company, you often have to give away a proportion of the equity, and there's the valuation issues around that, of course. But it is, as things stand, it is got to be, for this to work, these tax reliefs to be eligible, you do have to issue fresh shares to the investors under both of them, the SEIS and EIS. So different views on that. There's been talk about allowing it for loans, because it's quite common in the startup sector to have convertible loans in place that then convert to equity further down the line. As things stand, they don't qualify, which there's been quite a fuss about, and the government have been consulting on this, and they have made squeaks that they will look to relax it. But as things stand, that isn't in place. So we have to sort of watch this space on that particular one. So that's SEIS in a nutshell. As I say, it's a tax incentive aimed at early stage companies, and it rewards the investors for putting money in your company because they get tax relief on that investment they make. We'll run into the limits, restrictions, all the rest of it in future episodes. So that covers SEIS in a nutshell. This episode is brought to you by IP Tax Solutions, specialists in helping smart companies across the UK access and maximise government tax incentives such as R&D tax credits and the Patent Box, as well as SEIS and EIS. So you may be using your SEIS or EIS funding to develop new technologies, or maybe enhance or improve existing technologies, in which case R&D tax credits may be available to you. The R&D tax incentive is one of the single most generous sources of cash funding currently available for UK SME companies, with up to a third of the cash spent on qualifying R&D effectively being subsidised by the government via this tax incentive. There's no equity to give away, nor loan to repay or grant. Qualification for this tax incentive is extremely broad, with companies from almost any sector being eligible, so long as there is technical uncertainty at the outset. So why not contact us at IP Tax Solutions to learn more? Visit our website at iptaxsolutions.co.uk. You can call us on 0161 961 0096 or email info@iptaxsolutions.co.uk.